Hey, Kara Oosterhuis here with RealAgriculture.com. I am here today for another Real Ag Live episode, and I am super excited. We have a great guest here today. We are going to jump right into it, as I know a lot of you have questions on all things markets, and we have here today Chuck Penner of Leftfield Commodity Research. How's it going today, Chuck?
It's well, it was going great, Kara. How's that?
Absolutely. Words are tough. Absolutely. So moving into, I guess, a big question for a lot of producers right now is the impact of Tuesday's WASDE report. Can you talk a bit about what the market saw after it was released?
Well, the two big ones, of course, were corn and soybeans. Those were the ones that we're really watching. And so the USDA did a few things there. They made some adjustments on the production side for corn and took out a couple 100 million bushels. Then they also added some corn exports in, and so the effect is that suddenly that ending stocks look like they could be the tightest in about I don't know, 7 or 8 years or something like that. So it's a really rapid turnaround from where the market was looking earlier this year. Similar type of a picture for soybeans, where suddenly the ending stocks are looking like, oh boy, we're in the ballpark of some tight stocks. So what we saw an immediate reaction very quickly in the market. Beans were up, if I remember right, 40 some cents on the day, and but to a large degree, they've given a whole lot of that back already. So there was the sharp reaction, and you could say that was the funds or the algorithms or whoever bidding up the market and pushing it higher. But it's the market has come back to reality. And the way I would point it out is that we've seen the corn and the soybean markets rallying throughout the fall, through the middle of harvest, which is quite unusual. And so the market was already factoring that type of stuff into the situation. So the USDA number was a bit of a shocker, but the market was already trading in that direction anyway. So that's why it spiked higher and then came back down to, certainly not low levels, but it was a situation where the market was already heading in that direction. USDA, the WASDE report gave it a spike, and then it kind of, okay, we're already doing that, so we'll just keep on rallying. So yes, it's friendly, yes, it's supportive, but it probably shouldn't have come as a shock to too many people, because in this whole rally that we've had all fall, people are going, well, I don't know why it's going higher. I don't know why beans are going higher. They really shouldn't be going higher. And the same thing with corn. Well, now we know why it has been going higher, is because the bushels really aren't there, and because the export pace really has been going. The old USDA numbers before this, from last month, for example, with corn exports, everybody knew they were wrong. Everybody knew the exports to China, particularly. Everybody knew those numbers were wrong, and the USDA in this report said, "Well, no, now we're going to export. I think it's 15 million," and people still think they're too low. They're still wrong, and it should be closer to 20 or 20 plus or things like that. So it's it was a shocker, but not really. That's the short answer.
Yeah, absolutely. So speaking of kind of a shock in the markets, can you talk a bit about this past season, post harvest? It was probably one of the first years in a long time that we have. Usually, farmers are looking around harvest time, and those markets are quite low, but they were extremely high this year. Can you talk a bit about what some of those crops seen?
Yeah, it's been a bit of a situation. Most grain markets, if you look at them seasonally, what you'll see is they'll have their lows in the mid-September timeframe and then start to work their way higher. And that is the case this year. It's a matter of distinguishing whether this year that seasonal rally is a lot bigger yet than what a normal seasonal rally is, or normal seasonal recovery. So there's some normal stuff in there, but there's some stuff that's not, that's abnormal. So what we have is maybe I'll just back it up. The market is figuring out some of this kind of stuff, just like the WASDE report related to the U.S. crops. In Western Canada, we've had two StatsCan reports from in August and September. Both of those were these model-based satellite vegetation map type of estimates. We've never gone through this before where we haven't had a farmer's survey yet. That result will come out in less than a month on December 3rd. StatsCan will put out its I hesitate to say final production estimate, because they can adjust that years down the road. But what should be a more stable or a more realistic production number. So we have that kind of a situation. And so that's kind of the background to where we're at or what we've had. For the most part, we've had good yields across the prairies. That's no surprise. Harvests were generally earlier than usual in all three provinces, and southern Alberta, of course, always the earliest, but even earlier than early in southern Alberta. And so we've had a situation that early harvest has really set the stage for a good quality crop. We have some numbers from Sask Ag. They put out a grade estimate at the end of October, and generally crops are well above the 10-year average for the grades that they have. So that's positive generally, although the people who are hoping to play some grade discounts or grade premiums and being able to arbitrage the market in that way will have a more difficult time. So when you have a very good quality crop, there aren't the sizable grade discounts and those kind of things that you normally have. And so, yes, everybody's getting a better grade, but if you happen to have a number 115 protein wheat, it's not worth a whole lot more than a 2CW13 or something like that. So those kind of opportunities aren't necessarily there. So the Canadian wheat crop, I wish I had my spreadsheets open in front of me, because I kind of need to be looking at those. But all of these crops are looking at better than average yields, and the market is already, well, we could see some surprises in that StatsCan December report. And I would suggest that probably that report will most of the yield estimates or production estimates will be higher in that report than what StatsCan's earlier numbers will be. And some of that comes from price signals that we have. So, for example, if the production estimate for peas, just to take an example, if the production estimate for peas was accurate, we probably would actually have stronger pea prices than we have, even though they're great. We would probably have even stronger pea prices. So that's a bit of a signal that maybe there's 200,000 or 300,000 tons more there. There's probably a little bit more in the Durham market as well too. Wheat kind of gets bread wheat kind of gets mixed signals from overseas markets or things like that, but generally very positive as well too. And canola, again, I think we're probably going to be a little bit bigger than what StatsCan said, just because on the basis of exports so far and those types of things, I think we would have seen stronger basis levels, stronger futures and stronger basis levels. So it's not going to be a game changer, I don't believe. And generally, even we talked about the WASDE report before, but even for the WASDE report, the longer term impact of those reports is, I'm going to say, maybe 2 days. And then for StatsCan, it's more like 30 minutes, something along that regard. So it'll be interesting. It'll be helpful in terms of fine tuning S&Ds for the various crops, but it'll mostly clear up some question marks rather than set a new direction for the market.
Now, I know you like to follow Flax as well. What was S&D like with Flax, and as well as quality?
Well, the flax quality was very good. The harvest came off early. Normally flax doesn't take a huge hit from weather, but it did last year. This year, it's looking. I think it's probably close to 90% to one CW, somewhere in that area, and so that's been very positive for the flax market. Flax is one of these, though, is very non-transparent or untransparent. And what I would say is, based on the Canadian S&D, there's no reason why we should have $17, $18 flax prices right now. There's just no way. So there's something else going on in the market that we don't see. So that could be one where StatsCan will come in with a lower production number. But we also need to look outside of our borders to places like Kazakhstan and Russia. My worry or my caution with flax is that right now the bids that we're at, the $17, $18, are record highs. I can go back decades, and $18, give or take, is a record high. So we're at those record highs now, and I don't know what it would. I don't know that this year's market is that much different that would push prices even beyond that old record. My other caution is that some of my contacts in the Black Sea region suggest that the Kazakhstan flax crop isn't really any smaller than last year. About the same, give or take. Real hard estimates are hard to get. But what we have is, what I've heard is, the situation is that flax is just unable to get out of the country due to logistical things, due to farmers defaulting on their delivery contracts. One of the estimates out of there said that 90% of the flax contracts had been defaulted, because there aren't really any penalties for farmers who default on their contracts. So prices went up. Farmers just said, nope, I can't deliver. And so the caution is that flax hasn't gone away. It's still sitting there, and at some point it will get out of the country. So I don't think there's really any. I'd be hard pressed to find any real answer why flax prices could go higher than they are right now. That would be my question on that regard.
Absolutely. Now, shifting gears a little bit, Lindsay has a question here. What are your thoughts on barley and other commodities having issues out of Australia into China? Any thoughts on that?
Well, I have thoughts, yes. Let's see if they're any good. So the barley market for sure is affected by that. Canada has benefited tremendously because of China shutting out Australian barley. Australia finally had a better crop after a couple of really poor ones, and so their production could be anywhere 11 to 12 million tons, somewhere in that ballpark, so 2 or 3 million more than it has been for the last couple of years. So they suddenly have all of this barley, but China is set an 80% import tariff on Australian barley. There still is somehow, some way, there still is small amounts of Australian barley getting into China, but certainly not the volumes, the millions of tons that normally goes in there. So what's happened is Australian barley prices have dropped considerably, so that now they can be more competitive into other destinations. So especially Saudi Arabia, but other countries in Southern Asia, Southeast Asia, in those markets particularly, and maybe some into South America as well too. So it's helped Canadian exports. So Canadian exports so far are probably about double where they were last year at this time, which was already a very good marketing year. And so we've got that kind of a situation where we're benefiting. There's a lot of non-transparency in the Chinese market as well, though, too. So we don't know whether the extremely heavy pace they've been buying corn and sorghum and barley and DDGs is going to continue at that same level. I'm kind of thinking it'll be difficult for that to continue at that same pace. But even then, it's been very helpful. Even before this China tariff on Australian barley, Canada was already exporting a lot of barley into China. The one thing that we're probably going to lose out on, though, is last couple of years, Canada has also benefited in the Japanese market. So not enough Australian barley available. So we've captured a bunch of that Japanese market, but that is actually traditional Australian business. So that's it's been helpful for us, but and I think it will continue to provide support, especially with the corn market. I think that's providing a whole lot of lift as well too. In the last couple of years, we've been bringing just tons and tons of U.S. corn into southern Alberta, and with that getting more and more expensive, that has largely shut down. So those animals now need to either eat feed wheat or feed barley, or maybe even oats if they stay cheap enough.
And another question here is, while we're still dealing with the commodities, thoughts on the mustards, says Jim Hale. Obviously not the mustards. We should have him here to teach him some English, but yes, what can you tell me about the mustard market right now?
Well, here's one where I think StatsCan is going to have to come back with some larger production numbers in their December report. Mustard prices have been almost asleep for the last couple of years, and what we've got now is they are moving higher, but they're not the drop that StatsCan drop in production that StatsCan had in place in its earlier reports meant that prices should be 50% higher than where they are now, but they're not. And so what that tells me is that StatsCan has underestimated that crop considerably, and we'll see a bigger estimate come out in December. What we do though, because the gains in mustard bids for all three classes, for yellow, for brown, for oriental, all of them have been so gradual. They've almost been they've almost flown under the radar. So people just aren't thinking about the mustard market as strong right now. But if you look at yellow mustard bids, they're probably the highest in the last, I'm going to say, couple of years, and brown and oriental in at least a year, maybe a little bit longer. So they are moving higher, and that is going to help. What's really hurt the mustard market, and I'm going to say all three of them, is that we've had really poor demand for the last 2 years. And for the most part, that's related to more Russian mustard being available, Ukrainian, but mostly Russian mustard, which has taken some of that or more of the market share in Europe. So we've lost some of that. And it doesn't take too many tons for the Canadian mustard situation to look a little bit heavy. So that's limited the upside. So I think there's room for more upside, but it's not going to go screaming higher the way that the earlier StatsCan production numbers would have suggested.
So another question coming in here from Gerard on chickpeas. It says, "Will chickpeas come out if it's come out of its doldrums? What would be your summer target for Kabuli?"
See, I've been wrong on Kabulis. So here, just to get that confession out of the way. It's interesting because I was just looking at that in the last week, or well, I follow it regularly, but looking at it a little bit more out of the last few weeks. And so now you have, if you would have, here's another StatsCan question. So StatsCan was predicting 240,000 tons of production, and then they said we were carrying over 250,000 tons of old crop production into this year, which meant absolutely massive supplies of chickpeas going into 2020-21. If we believe those numbers, chickpea prices should be sub 20 if farmers were also selling. Farmers' stubbornness in not selling below 25 cents has kept that market supported. But we've been moving the chickpea market higher. Now we're, most 9mm bids are somewhere in the ballpark of 32 cents a pound, somewhere in that range. So you could argue that we are already out of the doldrums. The problem is, if you look back more than a couple of years and then you see the 60-cent levels when sample chickpeas were paying 35 to 40 cents, those kind of things. If you compare it to those, yeah, okay, we're still very much in the doldrums. But the strength that we're seeing so far, in my mind, isn't strictly a lack of farmer selling issue or that type of thing. It tells me that StatsCan's production numbers and their stocks numbers are are significantly too high. So those will change in December, I'm expecting. The other part of it is that Canadian chickpeas have had a really hard time competing in the last couple of years in the Pakistan market, which was our largest customer, probably still is our largest customer. And what we've been competing against is cheap Russian chickpeas, and those are 7-8 millimeter chickpeas. So that's I think that's resolving itself to some degree, and I think we should see better exports for the rest of this year. So that increasing demand, I think, is helping support the price. The other bit is most reports about this year's harvest are suggesting the Canadian harvest are suggesting that the Kabuli size is smaller. So if someone does have something with more 9 millimeters, 30-40%, they should be able to get a bit more of a premium than for the 7s or 8s, that type of thing. So I think that's where there might be a little bit more upside is strictly based on size. Oh, and I was supposed to have a summer target. Oh, geez, I hate those questions. I would say, based on the trajectory that we have right now, I'd say 35 is possible. A good chunk of that, though, is going to depend on what happens with the Mexican and Indian crop for both of those, because those both get harvested in roughly March timeframe. So depending on the size of those crops will really determine how much possible upside is. If the Mexican crop particular, and that's usually larger calibers too, but if that's a good size crop, then we'll struggle to get past 35, I would think.
Okay. So I wouldn't be me if we didn't talk politics just a little bit. What do you think Biden's government will do for grain markets?
Wow. Okay. Well, I'm going to have to do this without asking for or getting a whole bunch of enemies, because no matter what I say, it's going to do that. But I would suggest that, and I don't think I'm being just wishy-washy by saying this, but I would suggest it's not going to change things a whole heck of a lot, at least in the short term. And when I say short term, I'm saying 6 months to a year. What's probably going to happen is that some of the subsidy payments that had been going to U.S. farmers, that tap is going to shut off. I don't think that's going to continue. So that may push farmers there into marketing a little bit more heavily. That's not necessarily going to be too burdensome from the market, because supplies, as we're seeing now, supplies of corn and soybeans aren't all that heavy. So there isn't going to be an absolutely massive flood of soybeans and corn hitting the market. The other bit, of course, is going to be what is Biden going to do anything different in terms of trade deals, trade negotiations, and particularly with China? I would guess, and that's why I said in the short to medium term, I don't know that he's going to shake things up all that much with respect to China. I don't know that those kind of things, and frankly, Chinese have, all of the buying that China has been doing of U.S. soybeans and U.S. corn and wheat, for that matter, all of those kind of things haven't been based or haven't happened just because of strict trade, phase one trade deals or those kind of things. They've been happening because China needs the corn, needs the soybeans, needs the wheat. And those kind of situations aren't going to change no matter who's in charge in the US. So that type of buying isn't going to make a whole lot of difference. I don't think there's any willingness or interest in renegotiating a Canada-US free trade deal. I think that's going to be left for years, maybe decades, before someone tries to open that up again. So from that perspective, I don't think so. Maybe some in terms of the European market, maybe they'll resolve some of their differences, and then that'll get some of that trade moving again. So maybe more U.S. products moving into those as well too. But I think in the short term, the medium term, I think politics is going to take a backseat to weather. And one we haven't touched on, of course, is South American weather. I'm still baffled by the fact that people are still raising their estimates of the Brazilian soybean crop, even while it's getting drier and drier and drier there with forecasts for La Nina. And I'm not a big forecast guy, just so you know. But even there, I'm a little baffled by how those estimates keep going up instead of the other way. So anyway, that's my wishy-washy answer on politics. How's that?
That's awesome. So we got another question coming in here about faba beans. Lara asks, what about faba beans, Chuck? What can we expect?
Well, I think they're great. Is that the question? No, kidding.
Yeah.
No, it's faba beans are going to faba beans are going to struggle this year. Faba bean prices are going to struggle to rally from here. I don't think we'll see much downside, but I think they'll struggle to make further gains from where they are now. And the large reason is the Australian crop. Australia is looking at a crop that could be 500,000 tons, maybe even larger, and so that kind of dwarfs the size of the Canadian crop. And that they're going to be actively looking for export opportunities, which is largely Egypt anyway. So I think we're going to see a real challenge for getting the tannin fabas out the door into the export market. What I would suggest is that for the other fabas, for the snowbirds and those types, what we're going to see is that it will continue to ride the feed market higher. So as pea prices go up and feed pea prices go up, then feed compounders are going to be looking for other alternatives. And fabas again theoretically should be trading higher than feed peas anyway, based on protein. But that's gonna maybe provide a little bit of a lift. But I don't think we're gonna get much support from the export market for the tannins, and in some cases for some of the whites actually that get exported too. So going to struggle a little bit, but be supported by outside markets.
So in the last little bit across Western Canada, we have seen some pea processing plants pop up. Can you talk a bit about what that means for supply and demand as well? And is this a import-export conversation too?
Well, I think it is helpful. There's no question that it's helpful. I think the impact in 2020-21 this year is going to be fairly modest. We have the plant in Vanscoy, already running, and so that's not going to change this year necessarily. The big one that's coming on stream is the Roquette plant in Portage, and so that's going to consume some peas in this marketing year, but it's going to take a while for them to get up to full capacity. And so if they open in December and then start processing a little bit more in January and February, it is going to take a little while. Even at full capacity, and then there's another one in Winnipeg, close to Winnipeg, that's supposed to be opening up. For this year, it'll mean maybe a couple 100,000, maybe 300,000 tons of peas if everything goes smoothly. And so, yeah, that's going to change the outlook. But the P S&D is very, very tight already, so it'll make it tighter. But I'm already pretty bullish on peas, and so it'll maybe add a little bit more on the top, but I think the larger effects will be seen the following marketing year when both of those will be up and running at full capacity together with the plant at Vanscoy. That's when we'll see more of that. And so, if the long term, what I would love to see in the pea market is it become like canola, where about half is processed domestically and half is exported. I think the other long term thing for peas and for lentils and for chickpeas, I would say, um, is that it's going to be difficult without a lot of more disease resistance built in, or other plant protection um, f- features bred into these varieties. It's going to be really difficult for Canada to expand pulse acreage much more. And so what that tells me is that that'll keep the market supported. But then farmers in other countries where they haven't had those kind of rotation constraints so far, that's where some of that opportunity will move on the export side.
Which leads really well into our next question here from Brian Voth. And he says, could we be on the cusp of a bigger bull market like we saw in the 2010 to 2013 years?
I think so. It's kind of setting up like that a little bit, and one of the reasons I think that is, you have both the corn and the soybean market in the U.S. looking at a lot tighter supplies. So if you want to think about, well, where are the opportunities? High prices cure high prices. I understand that. But if you think about the acreage competition, particularly in the U.S., but that'll play out in South America as well too, is that you're not going to see one of them running away with acres, and so both will struggle. You can't have a massive increase in both corn and in soybean acres, and so that will tend to argue that it's going to take a little bit longer than a 1 year fix. It's going to require a little bit more of a extended production increase, extended acreage increase, or productivity increases, or whatever you want to call it. And that of course is within a framework of average weather or normal weather, whatever that is. So the areas where you will see production respond would be in areas like Russia, Kazakhstan, Ukraine. That's where some of that land, which is used marginally or hasn't been used for a few years or hasn't been used for many years, will get brought into production if prices are high enough. And so, again, that may not happen in the first year, may start to happen more in the second year. So it could be a couple of years anyway, again, assuming normal weather going forward.
Absolutely. So we have another question here from Gerard, and he says, I know price predictions can be tough. Red lentils have moved up considerably in the last 3 months. Can we expect further price increases past 30 to 31 cents?
I think there's a little more room. What I would suggest is on the red lentil side of the market, you will have the Australian crop coming in, and most of the private estimates are considerably higher than what the ag ministry there in Australia has been suggesting. So we're going to see maybe 400,000 or 500,000 tons of Australian red lentils hit the market in the next couple of months. So that's going to keep a bit of a lid on red lentil prices. And from there, February, March, then you have the lentils. And demand for green lentils tends to be more inelastic. If you look at long-term price charts, and I've been doing that a lot lately to get an idea of where could we get to, what's the upside potential. And I talked about flax earlier, $18. That's about it. For green lentils, it's looking a little scarier yet. So if you're a buyer, we've gotten to 60, 65 cents for reds, or for greens, sorry, not reds, greens, for large greens in particular. And for reds, we don't have that same kind of long-term upside. So it's a little more elastic demand. When you get up past 35 cents, I would say you're probably going to lose countries like Bangladesh, Sri Lanka, Pakistan as buyers. So that can be more elastic demand. So yeah, I think we got a little more upside, but not a ton.
So before we wrap up here, one more quick question. Now, there's been a lot of railway companies, CN and CP, are reporting record movements so far this year. Can you touch a bit on this and what your take on this is?
Yeah, people are naturally suspicious of railways, aren't they?
Yeah.
But in this case, And I have friends who work at the railways, so I have to be careful. But no, in this case, they're legit. Canadian exports of wheat are up over 1 million tons compared to last year. Same thing with canola. So those are our two big crops. Oat exports are the highest that I can find going back probably about 25 years. Barley exports are double last year. And we know that peas, September was a record month ever for pea exports. Lentil exports are extremely strong as well too. Durham is just really starting to pick up now. I'm just trying to think what else. So yeah, everything is firing on all cylinders, and maybe an extra cylinder or two. So no, I think those are legit. I think I got friends there, so it's good to be uh, to be supportive of the railways, and not just criticize them, because right now, I think what's happened though is that the constraints or the difficulties we've had in previous years have now set the stage for having this good year, and things will slow down. We're going to get this. I mean, we've got snowstorms already, but we're going to have more of those, and there will be glitches. But this start this year has been great, and they added. The thing I want to point out with respect to that is that because we've moved so much of our grain in the first quarter of the marketing year, it just means there's going to be a lot less available for the rest for the last 3 quarters, and so that is supportive for prices. And we hope to see futures show a little more strength, basis levels show a little more strength, and cash prices as well too. So we're pretty positive.
Well, yeah, and like you said, no matter how we all criticize what's going on around us, but those railways keep our industry alive, so it's very important that we touch on that too.
Sure.
So I know I said that was the last question, but we got one more, and then I'm cutting you guys off. Do you use any strategies in the commodity market to lock in prices?
Well, I don't, because I don't trade, but that helps me stay independent. But no, there's all kinds of ways depending on which type of market. If it's futures markets, of course, there's different hedging opportunities or options opportunities, those types of things that are. And my partner John is more expert in those kind of areas, but no, the difficulty this year is, um, we had a lot of talk in the last couple of years about being disciplined marketers and selling at a profit and things like that. And now with prices all kind of, taken off like that, some of that discipline has kind of gone out the window. And now it's kind of, how high of a price can I possibly get, rather than, locking in profits, selling into rallies, all of those tried and true marketing practices that we've had, and that we've talked about using, selling in the top third of the market. And, like I said, a number of these crops, we're well into the top third, and some in the top 5% of the market. So, all of those kind of maxims or marketing practices, or truisms, whatever you want to call them, all of those kind of things are applying this year, and farmers are taking advantage of them. I get that, but it is just so tempting. When you see the market going like that, and it's more about trying to call the high in the market, as opposed to making sure that you've got a really solid profit. And I can't think of any crops right now where you don't have an opportunity to make a really, really good profit. So it's a great year.
Yes, absolutely. And on that note, we are going to wrap up. Thanks for all your questions from the audience, and thanks for all your insight, Chuck. It is always very interesting to hear what you have to say and how you're looking at the future. So it's really great. But thanks again. And for those of you that have tuned in, thank you for joining along. Like I said, we would not be able to do this without you. So we appreciate it greatly. Be sure to tune into Rural Radio 147 at 2:30 p.m. Mountain Time on Sirius XM. Today is our Farmer Rapid Fire, so host Sean Haney will take you across the country, and we'll talk about we talked to a few different farmers talking about what is going on, and he asked them all one question: what are the Biden presidency impacts? So along with some great news, Sean will have the top ag news stories of the day, as well as what these producers have to think about this. So it's definitely a topic you'll want to join in for. And thanks again for joining us. I will be your host again for tomorrow's Real Ag Live. So be sure to join in, same time, same place. Come with all your questions, and we will get them answered.